Hi everyone. In this video, I wanted to bring to your attention one growth stock that's down 69% that I think you might regret if you don't buy it on this dip. But before I reveal what that growth stock is, I'm going to highlight some of its financial metrics, and then towards the end of the video, I will reveal that growth stock. So let's get right into it, starting with this company's revenue. And what I have here is a chart of its trailing 12-month revenue going back to 2019. And you can see very nice upward trend line here for this company, although the growth has slowed down, as you could see, as economies reopened. Still, the company's revenue at 2.8 billion is higher than around the 700 million it was at in 2019. So during the pandemic, yes, this company benefited, although even afterwards, it's stronger than where it was before the outbreak. So it's made considerable progress. And one of the headwinds this company faced in the first quarter was that advertising spending slowed down considerably. If you look overall, the advertising industry worldwide in the first quarter of 2023, spending was down 7 to 8%. However, that rebounded strongly in the second quarter, and forecasts indicate that overall spending will be up for the year around 5%. So after starting down close to 8%, the year is going to end up 8%. So you can see what kind of recovery is needed to make it better for the rest of the year. And this company will benefit since it relies almost exclusively on ad revenue for its overall revenue. The next chart I have pulled up here is this company's cash flow from operations to sales. And I like to see this number being as large as possible because it means that the company is doing a good job turning sales into cash flow. And again, you see a very nice upward trend here with a big move higher during the pandemic in late 2020, early 2021, throughout 2022, and then a moderating rate as economies reopen, but still solid at 15.5%. You could draw a line down to 2019 and you could see a nicely upward trending line here, and this should continue to improve or at least flatten out here because revenue is likely to rebound and the company's made cost cuts and cost efficiencies to streamline expenses. One of the moves I'm a big fan of is reducing office space, allowing employees to work from home, because I feel that's a win-win situation. It lowers costs for the company and it makes working for the company more pleasurable for employees, and I see that as a win-win, and I'm glad this company is one of the ones that's sticking to that remote work policy when others are trying to get people to come back to the office, which I see as a bit of a wasteful expense, especially for certain types of companies. Lastly, I will highlight the company's valuation. What I have here is a chart of its forward price to earnings ratio, and this stock is trading at a forward PE of 27, which is down significantly off its highs, and it's not expensive if you look at the company's growth rate, right? The company is growing very nicely, generating solid cash flow from operations. Typically, companies like this you expect to pay a premium valuation for, but it's not really trading at that much of a premium valuation. So, what is this company? This is Pinterest. Pinterest, the image-based social media company that struggled in the first quarter of the year because of declining ad spending because of the privacy policy changes implemented by Apple. But Pinterest is finding nice ways to work around, and its second quarter recovered nicely, and I would not be surprised if the company reported excellent results for the rest of 2023. For those reasons, I think Pinterest is one growth stock you might regret not buying on this dip here. All right, but that's all I've got for this video. Thank you so much for watching.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.